Markets in a risk-off mood again this morning after a turnaround yesterday. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Trump's team pushes for trade talks with China as the president presses reluctant Republicans on his multi-trillion-dollar tax bill. And Wall Street titans are gaming out how to profit from this policy uncertainty. We'll hear from AQR's Cliff Asness as well as Marathon's Bruce Richards in this program. Plus, the Texas Stock Exchange challenges the NYSE and the NASDAQ. We'll hear from the man helping lead the charge, former Congressman Jeb Hensarling. Katie, what are you watching?
Well, it's still earnings season, so I have my eyes on Dollar General, out with a beat and a raise. The retailer easing tariff concerns, with the CEO saying that they're uniquely positioned to serve customers in a variety of economic environments. Obviously, traders seem to like that. The stock is up about 10% pre-market, Matt.
Wow, big boost there. We're also watching Meta, the owner of Facebook, buying nuclear power from Constellation Energy as AI sends power demand soaring. You can see Facebook shares right now, little change in the pre-market, but Constellation up more than 11%, Katie.
And on the policy front, President Donald Trump still pushing for Senate support of his big, beautiful tax bill. The president wrote on Truth Social yesterday that, quote, "What nobody understands is that it's the single biggest spending cut in history by far. There will be no cuts to Social Security, Medicare, or Medicaid," a key flashpoint in the debate. Former acting chief of staff Mick Mulvaney had this to say about the process.
The Senate is under no way, no circumstances, ever going to accept what the House sent without any changes. So this is just round two of at least three. I think, as Linda, that this July 4th date is completely artificial. The important date is this. Buried in this bill is the increase in the debt ceiling. Scott Bessent has said that the Treasury runs out of money, I think, effectively sometimes in mid-August. That's the real date here. That's the hard deadline.
Let's get the latest from Bloomberg's Washington correspondent, Tyler Kendall. She is at the White House. So, Tyler, what do we know about how powerful the president will be in convincing these senators to vote for his one big, beautiful bill?
Yeah, hey, Matt. Well, he's definitely starting to ramp up the pressure on these senators, hosting a sweep of calls last night to some of those key holdouts that say they are threatening not to vote for the bill unless they see their demands met. And there really are conflicting demands here. On one hand, you have this group of Republicans pitching themselves as fiscal hawks, perhaps led by Senator Ron Johnson of Wisconsin. He's one of those senators that did get a call last night. He wants deeper spending cuts and has taken issue with claims that new tax priorities, like no taxes on tips or overtime pay, really incentivize growth. On the other hand of this, though, are those Republicans that are raising concerns about changes to benefit programs, such as Senator Josh Hawley, another senator who got a call last night. Of course, this is a politically fraught issue for the White House when it comes to changes to Medicaid. And as you read at the top of the segment, President Trump is pledging that ultimately there will be no cuts to Medicaid. But there's a few different analysis out there, including one cited by Bloomberg News, that shows that 7.7 million people by 2034 could see their coverage lost due to shifting eligibility requirements. Now, I could keep going. This is, of course, one big, beautiful bill, so there's a lot of disagreements in here. But I would also pay close attention to what happens on the tax cut front. There's some senators that want to make some of the temporary provisions permanent. And then lastly, Matt, since I know you watch this closely, there's some disagreement about the SALT cap. We had Senator Kevin Cramer on Balance of Power last night. He suggested that a sweet spot for that cap could be between $20,000 and $30,000. Of course, that is lower than the House plan of lifting it to $40,000.
And that is certainly not good enough for Matt Miller. And July 4th is quickly approaching. So,
or any of those who are in favor of states' rights. This is a states' rights issue. And I think a lot of people forget that, right? The idea is if you cap the state and local tax deduction, you're centralizing power, pushing it towards the federal government in Washington.
Well, we only have like 2 minutes left with Tyler, so I have to ask you about China because we played a little bit of Mick Mulvaney at the top here. Something else he said was about the concept of a President Trump, President Xi phone call, which we talked about yesterday, Tyler. He said that there's a fundamental disconnect here. Trump wants to talk at the very highest levels. That's not always how the Chinese want to do business. So, Tyler, it seems like we're in a little bit of a standoff here when it comes to actually getting these two on the phone.
Right, it really does feel like a holding pattern, and key to Mick Mulvaney's comments was that line that you highlighted, a fundamental disconnect, since we know that China really would like to see key advisors iron out the details before they put Xi Jinping on the phone, and it does seem like some of those key details continue to mount here. The other part of this is that there's just so much uncertainty, and we know that's something that China doesn't really want to put their leader in a position of getting on the phone with President Trump when there still isn't really exact clarity on what this White House needs to see in order for a deal to get done. Now, I mentioned this yesterday on this program, but I did have the chance to catch up with the Deputy Treasury Secretary, Michael Falkender, who told me on one of those issues, eventually, it really is going to come down to a phone call between the two leaders, and that's when it comes to the U.S.'s accusations that China is slow-walking those export licenses when it comes to critical and rare earth minerals, saying that that's going to be one of those top priorities that these two leaders do need to discuss. The White House, it's clear, thinks that that's one of those issues that could be resolved in that way.
All right, Tyler Kendall, great reporting as always. We'll be checking in with you again very soon. But let's turn to the corporate front here, because Constellation Energy has reached a deal to sell nuclear power to Meta. Meta plans on using the energy to run its data centers. You can see the news powering nuclear stocks higher pre-market, including Constellation, up about 12% at the moment, and the whole sector as well. Let's break it down now with Bloomberg Power and Renewable Energy editor Will Wade. So let's start with the logic of this deal here. This is a 20-year contract. It starts in mid-2027. So clearly, Meta plans to use this power for quite a long time.
Oh, yes. We're seeing so much demand for energy from all the big technology companies. They've got data centers that need more power than ever before, and they're building so many. The demand for electricity in the U.S. has pretty much been flat for decades. And then all of a sudden, about a year ago, it really started to jump. So this has caught the energy industry kind of flat-footed, because it takes a long time to build power plants. They're big facilities. So for Meta, this is like a facility that exists now.
Mm-hmm. So we didn't get the financial details. We don't know how much they're paying, right?
No, and don't think I didn't ask Joe Dominguez, the CEO of Constellation.
I mean, I'm guessing you can kind of ballpark it from the Microsoft deal. But
yeah,
my other question, aside from how much, is does this push Constellation to open up another reactor there?
They're talking about it, and that's really significant because we haven't had a new nuclear power plant in the U.S. in a long time. We had the Vogtle plant that was finished last year, and it was like 7 years late. It was billions of dollars over budget. And I went down there for the grand opening, and there were all these people saying, let's do another one. You know who wasn't saying that? Southern, the company that lost a ton of money trying to build it, because nobody wants to be on the hook for the costs. So what I've been hearing ever since then is we'd love to build a nuclear power plant if someone else will make sure that they'll pay for it. Tech companies have big money.
All right, Will, thanks very much. Bloomberg's Will Wade covers this stuff, and as he said, he goes to these plants. He braves the radiation to bring you the news that you need. Staying, though, in the land of big tech, Microsoft eliminating 300 more jobs just weeks after cutting thousands last month. Disney also announcing job cuts. Here with more is Bloomberg technology co-host Caroline Hyde. And Caroline, 300 is not a huge amount, relative to the rest of Microsoft's workforce. But what's going on here?
Well, you need a lot of power for AI. You don't need so many software developers and engineers, it seems. And so actually, when we saw 6,000 people cut from Microsoft, that was announced back in May, a large proportion of those people who were said farewell to are indeed development engineers here. And that's because we're seeing Satya Nadella, the CEO of Microsoft, say we are doing about 30% of our coding now via artificial intelligence. So everyone's trying to rework their workforce, whether that means you need fewer software engineering talent, or that means you actually just need to go out, goodbye to the old, in with the new, reorientate yourself. Look, we heard similar things coming out of Salesforce. So as they gave us their numbers last week, we heard that they too are perhaps not having to hire at the same pace as usual. They're able to slow hiring, and instead they're beefing up the sales department because they've actually got all the product, and now that they're able to start selling a little bit more rapidly. But this is really being echoed across the technology front. You're seeing people get leaner and leaner and focusing more on putting money on the energy side, the infrastructure side, and just developing the AI product. But for that, perhaps you need fewer people.
And it's interesting to note that we're having this conversation ahead of 10 a.m. JOLTS data when it comes to job openings. And of course, the payrolls print on Friday. You mentioned that you're seeing this across the tech industry, but it's not just tech. We got some interesting news from Disney yesterday, also planning to lay off several hundred workers. And they've laid off really thousands of positions in recent years.
I think it's about 8,000 have gone in recent years from Disney. Now, this is, again, not large when you think about 250,000 people that Disney currently has under employee base. But they are shedding a couple of hundred, it seems, once again in the content side. So we're thinking marketing. You're thinking just the way in which you're going to go out and promote movies and content. They're slimming down there once again because times are tough. They want to make fewer movies, get more bang for their buck. And we know what's happening to content, the amount of shakeups that happening at Comcast, the way they're selling off MSNBC and CNBC. You've seen, of course, Paramount thinking about its own costs and being leaner. Warner Brothers has done a big overhaul as well. So this is, again, a restructuring vibe. And when you just think across the whole plethora here of technology and content, people are just trying to reorientate their workforce for a future. I go back to Microsoft saying, look, the spokesman saying we continue to implement organizational changes necessary to best position the company for success. It's a dynamic marketplace.
Well, it'll be important to see when all of these stories that we're talking about individually start to show up in the overall economic data. Great roundup, Caroline. That is Bloomberg Technologies' Caroline Hyde. And be sure to tune in tomorrow as the Bloomberg Tech Summit gets underway in San Francisco. We'll hear from industry leaders, including the CEOs of Uber, Rivian, and Peloton. Caroline and Ed Ludlow will have a special edition of Bloomberg Technology live from the event on Thursday at 11 a.m. New York time. Certainly don't want to miss that one. But let's take a quick check on these futures right now because those pre-market losses lessening right now. The S&P 500 down just 0.1% about 20 minutes ago until the bell rings. We saw something similar yesterday, really pre-market losses, and then American investors woke up and started bidding up stocks. So we'll see if the same pattern holds true today, Matt Miller.
Yeah, I mean, yesterday we had NVIDIA, attempting to lift the market. At one point, you were checking stocks and 400 were down, but NVIDIA was up, and that was enough to bring us back. And by the end of the day, of course, that breath turned around as well. Coming up, Dollar General is raising its outlook on hopes that shoppers will look for more deals, specifically there at Dollar General. Those details next. This is Bloomberg. Let's get now to higher interest to look what's making headlines around the world. NATO is asking European member states to expand ground-based air defense capabilities fivefold as the alliance races to fill a key gap in response to the threat of Russian aggression. The ramp-up will be discussed at a NATO defense minister gathering on Thursday. The alliance is already planning on boosting its weaponry and air defense systems as it scales back reliance on these United States of America. Elon Musk is selling $5 billion in debt for his artificial intelligence startup XAI. It's the latest in a series of fundraising efforts across his business empire as Musk pivots away from politics and returns to running his various companies. Morgan Stanley is shopping the debt for XAI with a double-digit interest rate. The financing could help Musk spend aggressively on AI infrastructure as he builds out a massive data center in Memphis. And JP Morgan is putting Marianne Lake, one of the leading contenders to one day take over for Chief Executive Officer Jamie Dimon, in charge of strategic growth in the firm's fastest growing overseas consumer bank. The appointment follows the departure of Sanoke Viswanathan, who's leaving to become the CEO of data company FactSet. Lake has been serving as the CFO at JP Morgan. And let's get some breaking headlines right now from Ford. Electric vehicle sales in the month of May have fallen 25% from the same month a year earlier. Meanwhile, all U.S. auto sales rose 16.3% in May, and that's due to strong truck sales, which is pretty much the main thing Ford sells, Katie, aside from the Mustang platform.
There you go. Really interesting news about the EV sales, though. We'll continue to follow that story. But let's switch gears here and talk about Dollar General. An interesting earnings report out this morning with the dollar store showing that it can manage the Trump administration's trade war. The firm also raised its annual guidance despite heavy exposure to China and a slowdown in shopping trends. The CEO just saying now that they are seeing more high-income customers. Bloomberg retail editor Emily Cohn joins us now to discuss. And I want to focus on that last part, the CEO saying that they're actually seeing more high-income consumers coming in and shopping at their stores. What does that say about the economic environment that we're in?
Well, these types of stores, dollar stores in general, tend to do well in these types of environments. We see low-income shoppers coming, but also higher income shoppers trading down and coming to Dollar General. So it says that shoppers are feeling squeezed and coming to Dollar General because they know they can get a bargain.
It's interesting. I can imagine high-income shoppers trading down to Walmart.
Yeah.
But I feel like trading down to Dollar General is maybe like a consumer cry for help. Is that
That's true.
much?
Dollar General also has this their footprint advantage. So we're talking about rural shoppers here when we're talking about Dollar General. That's their real advantage. In lots of areas of this country, the closest store where you'd go out to get a gallon of milk is going to be a Dollar General, and that's their real advantage here. Looking forward, this battle for the rural shopper is a big area that we're looking at. They're getting more competition from Walmart and Amazon. And these rural shoppers are really where the battle is heating up.
It's a great point on the geography that we're talking about here. We're getting some other comments from the company saying that it expects some price increases from tariffs. They've managed to navigate pretty well thus far, it looks like, looking at their results. But talk to us about their exposure to China.
So they're in a good spot relative to their competitors because a bulk of their sales come from consumables, groceries. Those things tend to be less exposed to tariffs than the other aisles of the store. So they, in this report, they said that they took into account current tariffs rates, and they actually raised their guidance a little bit. So they have an exposure to China, but I think it's something that they can mitigate, and that's why the stock is up this morning.
right? Mitigating that in part by raising prices.
Yeah.
All right, really interesting stuff. Thanks so much for joining us. Emily Cohn covers retail on the BN side of the building. Coming up, BlackRock's Gargi Chaudhuri says the banner month for markets in May was masking dispersion under the hood. We'll ask her what that means next on Open Interest.
We've all seen what's happened with the VIX and volatility in the equity markets this year. This will not be a calm market. The market is expecting some sort of resolution or some sort of progress. If they don't get that progress and we go the opposite way and we start putting in more and more tariffs and not making progress, we're going to have a problem.
And that was Wells Fargo strategist Chris Harvey, who holds the title of the biggest bull on Wall Street. Meanwhile, you have Deutsche Bank lifting its S&P 500 target as markets recover from trade shocks. Specifically, the firm lifted its year-end forecast to 65.50 from 61.50. That implies a 10% gain from Monday's close. Joining us now at the desk to discuss it all is BlackRock Chief Investment and Portfolio Strategist of the Americas, Gargi Chaudhuri. Gargi, great to see you in person.
It's good to be here.
So I know that you don't have an S&P 500 target, but I'll ask you the same thing that I asked Stuart Kaiser 24 hours ago, which is, if you did, would you be lifting it right now?
So it depends on when I set those targets.
Right.
If we did that, if we had set it on April 3rd, then perhaps, yes, we would be lifting it. Because obviously, over the course of the month of May, we've received a lot of positive data, not only on the tariff negotiation front, but on the earnings front. And that means something. We're also seeing that the soft data perhaps is lifting from the terrible levels that it had gotten to in April and May, and the hard data so far remains okay. So depending on when people set their targets, I think there are some reasons to be a little bit more optimistic, and I think it's all related to earnings. Having said that, we haven't gone back to the Feb 19th levels because there are some reasons for that too. Growth is slowing down. We have to be cognizant of that, and we're questioning whether we can get those Fed cuts that are priced into the market.
That's right. Earnings estimates are lower than they were in February, lower than they were on April 2nd. And we had the OECD, for example, come out this morning and say we don't expect 2+% growth anymore for the U.S. Now it's 1.6%. How much does the Fed need to cut? And are they going to be able to do that if we don't get some clarity on the tariff policy of the United States?
Yeah, that's exactly the right question, Matt. I think when you look at what's priced into the market, give or take 2 cuts, I think it's a probability-weighted outcome. So if things get really bad, and by the way, the chances of a recession coming through by the end of this year, those chances are dropping from where they had gotten to, right? Many people are pulling back their expectations of a severe slowdown. But for example, if there were one were to happen, you could see 3, 4 rate cuts. At the same time, if we're fine, if the labor market, as we might find out later today and through the course of this week, if the labor market remains resilient with no massive job destruction, I think the Fed doesn't need to go at all, or maybe just once towards the end of the year. So the probability adjusted outcome of those two look like about 2 rate cuts. Do they need to go if inflation is sticky and growth still lower, but still about a 1% level? I would say maybe just once.
All right, Gargi, you're sticking with us through the opening bell. We'll see you on the other side of this commercial break. Let's take a look at the setup as we count down to the ringing here. You can see the S&P 500. It feels like it wants to go green. We were looking at much steeper pre-market losses just a few hours ago, but right now down about 0.1%. The NASDAQ 100 is already there, pretty much flat, but the color is green. But it's the small caps out in charge, Matt Miller. The Russell 2000 up about 0.4% with about 4 minutes to go until the open.
Wow, we still look at the Russell 2000.
And we should.
We're going to continue, right? You're going to keep that on the board?
Until they drag me off the
there?
set. Ugh, a price-weighted index? Can you imagine?
You know what? We'll change it on the World Equity Index screen as well. We'll replace the Dow.
Thank you. I appreciate that.
The Russell 2000. Coming up in just over 30 minutes' time, we're going to sit down with Cliff Asness. He is, of course, the billionaire founder, co-founder of AQR. He's going to tell us how his firm has gotten double-digit returns even amidst volatility. This is Open Interest. We are moments away from the start of trading on this Tuesday after a turnaround. Yesterday, it looks like markets are struggling to push higher. Again, you can see S&P futures right now down, but only 0.06%, and we were off much more at 3 o'clock this morning when I came in. NASDAQ futures are also very little change right now, but the Russell futures looking good, Katie. In terms of the opening bells, you've got Olo right now ringing the opening bell on the New York Stock Exchange. They're down 60% over the past 5 years, so I feel like they can do better for their shareholders. On the other hand, SS Innovations, surgical supply company, they have more than doubled in the past 5 years. In fact, they're up 114% with all dividends reinvested. So
there you go.
They've done pretty well. Dollar General's doing well today. What are you watching?
Doing pretty well. This is the last gasp of the current earnings season, and it's Dollar General out with a beat and a raise. The retailer really easing those tariff concerns. You have the CEO saying that they're uniquely positioned to serve customers in a variety of economic environments. We also heard from the CEO saying that they're seeing higher income consumers come into their stores, so really benefiting from that trade down that we're seeing. Matt Miller currently up about 11% just minutes after the bell.
And Meta, obviously, is one we've been talking about this morning, buying nuclear power from Constellation Energy as AI sends power demand soaring. But the 20-year contract doesn't start until the middle of 2027, which seems like
a lifetime away.
Right? That's a long way from now.
We'll see.
We'll be past the midterms. It could be a whole new world.
Life could look totally different.
All right, we're back with Gargi Chaudhuri, BlackRock's Chief Investment and Portfolio Strategist for the Americas. And Gargi, obviously AI and power was everything last year. Is it everything again this year?
I think it is. I think it can be. When we look at what drove much of the market performance from the April 2nd lows, a lot of that is coming from the earnings power and the earnings growth we've seen in the large cap quality companies, many of those that have a software or AI theme associated with them. Every time, we're all as market participants wait for NVIDIA earnings, we continue to be amazed by the revenue growth. We continue to be amazed by how much all of these larger companies are investing in CapEx. And that is a big driver of growth for the United States going forward. So I do think this will be a mega trend, a mega theme that will be with us for 2027 and beyond. And now I think it's broadening to areas such as power, such as one of the things that we talk about in our outlook around software. And I think that's with us to stay for some time.
This is a question that I've been asking, it feels like, for the past year, and I've probably asked you this question before, but you mentioned that now maybe we're talking about software. It feels like so long the AI trade has been the enablers, it's been the picks and shovels, the NVIDIAs of the world, but it seems like maybe some of the interest really is starting to migrate to the application of AI.
Absolutely. It is starting to move to the application of AI, but I also think even within that, there are going to be winners and losers, right? So we're, in our outlook, we talked a little bit about just pure software exposure with something like an IGV, which is our iShares ticker, but also broadly, we talked about the need for being very active and nimble around it, because some of the names that are working now within software may just not work in the next 2 or 3 months. So really focusing on actively managing your AI and tech exposure, which we think is a much smaller component of our clients' portfolios than they think it is. So really focusing on things like BlackRock active innovation and tech funds, which is, again, an active way to manage your AI exposure and your broader software and tech exposure.
I will note that we're going to talk a little bit later to Bruce Richards. He posted on LinkedIn last week that he expects more distress in software because, well, the reason it's interesting is because private credit and private equity have really piled in. Does it matter? I guess there's dispersion there.
There's dispersion there.
Yes.
That's exactly the sentence that you had started us on. There is going to be dispersion, which is why you can have a theme in your portfolio, but if you're looking for the next 3 to 4 years, being active around that, being able to dynamically rotate between one theme to another, we think is important.
I want to talk about the economic environment a little bit, because we were talking about Microsoft and Disney layoffs a little bit earlier. We get jolts at the top of the 10 a.m. hour, and then it's the all-important employment report on Friday. It seems like there's some expectation that we're going to see a little bit of cooling in the labor market, at least as it comes through with this JOLTS data. What's your expectation there? We're starting to get those headlines again, but we haven't yet seen it in the data.
Right. So we haven't. The one thing that I think the market paid a little bit of attention to is just the pickup last week in the initial jobless claims. Obviously, this week's JOLTS, which we've seen, again, we've seen a cooling, but I would say that cooling in all forms of labor market data is much needed right now. So we've seen a cooling in the job openings rate. I think we might see a further cooling in the non-farm payroll number that comes out on Friday. What might that look like? Could it be somewhere between 130, 140? That's lower than the 3-month and the 6-month averages, but still a very solid pace of job growth from at this stage of maturity for the U.S. economy. What I will particularly, look, it's a mature
Matt's
economy.
getting nervous.
This is
an economy that's growing
cooling,
at 1%.
Right? But, Torsten Slok sent out a message today. Okay, 120, I guess, 130 for now, 120 for June. We're talking consensus here. 64 for September, 66 for December.
It's not very many thousands.
That much cooling would not be good,
That much cooling would not be good. So obviously, if tomorrow or Friday's number was significantly, and by significantly I mean 50 to 75,000 lower than expectations, and it was dispersed across many categories, across goods, and most importantly, across the services sector, which is where much of the job growth has come from. If we saw that, I think the market will certainly, the front end of the fixed income market will certainly price in some action from the Fed. But as of right now, that is not the expectation. I think there is going to be cooling. We should get used to that. There's another, there's obviously a lot of immigration outflows, or based on how much immigration has been a driver of job growth in the last year. We have to take into account that that is not going to be the case. So again, other reasons for softening there. I think market knows a lot of that. But obviously, there is a point at which it's a bad softening, not just a cooling, but something that makes us all afraid.
Makes me uncomfortable.
I don't think we're quite there yet. I think we're still looking at a U.S. economy, at least at this point, where the labor market is one of the shining spots.
Well, Matt is sweating over here, so let's try to get him a little bit more scared. I want to game plan that scenario the next few months where maybe, okay, you get a cooling down that turns into a softening in the labor market. Let's say inflation does have a little bit of pressure under it and it reignites a little bit. We had a note from JP Morgan yesterday, actually, writing that they think that we could enter into a stagflationary episode here that would end the S&P 500's rebound. Can you rule that out, or do you have to keep stagflation risk on the table?
I think you have to. I think the direction of travel could be in a stagflationary direction. Obviously, a lot of that depends on the growth expectations from the tax bill, as well as how much of the tariff unwind really, catapults many companies to go back to spending and manufacturing and all of that. So we are going to learn more about it. But this is why we talk a lot about adding diversifiers in your portfolio. So to the extent that many portfolios that we analyze have had a very high percentage allocation to U.S. equities, we're telling investors, close your underweight to the other areas of the world. Close your underweight to emerging markets as well as European equities. You don't have to go overweight here, but certainly sort of have a more diversified portfolio. Add things like tips. Add things like gold. These are areas of the market that we think could do well in that stagflationary environment. And very importantly, market neutral strategies that have a low beta and a low correlation to the broader S&P or the NASDAQ or the Dow that I know you love to watch. I think that's going to be another source of diversification much needed when uncertainty is high.
All right, Gargi, that's a good place to leave it. Great to see you again. That is BlackRock's Gargi Chaudhuri. Meanwhile, let's get a check on this market and take a look at the setup, because we're taking a look at breadth again. And similar to yesterday, it's not awesome right now. It's not quite as bad as yesterday when we had more than 400 names in the red, but you can see we have more than 300 in the red right now, 176 pushing to the upside. Once again, it's NVIDIA that is leading the charge. Small move overall, but when you're that big of a company, that makes you the biggest gainer on a points basis here. You also have Broadcom, Tesla, and Constellation Energy higher right now. Take a look at the downside, though. This sticks out to me. Keep an eye on Alphabet, because once again, this is your biggest loser right now. If this holds, this will be Alphabet's 5th straight day of losses, down another 2% right now. Let's take a look at how this looks on the sector basis as well. It's close to an even split. I'm not quite sure if this is quite it, because I believe that I had tech at the top right now, but you can see we're talking about small moves overall. Utilities up top right now, up about 0.5%, industrials, and then tech. It looks a little defensive to me, Matt Miller. And then you take a look at the bottom. It's real estate, materials, and communication services leading the way lower right now, Matt.
Yeah, no, it does look defensive, but I think that's because of Constellation, right? So usually if investors are buying utilities, that's a sign that they may be a little bit scared. But today you've got Constellation up on the Facebook headlines. I want to also point out that if you're watching the breakdown of the Dutch government, the prime minister has offered to resign and continue in a caretaker government. Of course, that government fell apart because the coalition came unglued. When we come back, we're going to talk about something maybe a little closer to your heart, and that is Texas and the stock exchange in the Lone Star State. Texas is preparing for its stock exchange debut in 2026. We're going to speak with former Congressman Jeb Hensarling, who is now strategic advisor for the TSE. Next, this is Open Interest. This is Bloomberg Open Interest. Quick check on stocks, and we are looking at gains right now, just barely, obviously, so I guess little change is a better way to put it. But they're not losses on the S&P 500 at 59.38. That's the cash trade. We're looking at a little bit better NASDAQ 100 trade right now, up 0.1%. You can see that the VIX is also unchanged right now, trading at 18.4, and Russell gaining about a third. In terms of the individual movers, NVIDIA once again pulling us up on the day, gaining more than 1%, which it's a $3.5 trillion stock. So that means a lot to the indexes on which it is listed. Tesla also a gainer today. You can see Facebook down after that deal with Constellation, but only about 0.4%, and Constellation itself gaining almost 7% on that new power delivery contract. Katie?
We'll continue to follow that story, but let's turn our attention to Texas. The Texas Stock Exchange has filed its Form 1 registration with the SEC to register as a national securities exchange. Reporting says it has secured over $161 million in funding as it aims for a 2026 launch. Joining us now, I'm thrilled to say we have Jeb Hensarling. He is the Texas Stock Exchange Strategic Advisor and former chairman of the House Financial Services Committee, as well as Julie Fine, our own bureau chief down in Texas. And Julie, a great time for this conversation because I know Jeb, sitting next to you, has some big plans.
There are some big plans. You do have a pretty aggressive timeline, Congressman. Thanks so much for being with us. Sure. Are you still expecting the SEC approval coming later this year and the trading to begin in March or in next year, 2026?
Well, first, Julie, thanks for having me. This is the most exciting project I've been involved in since I left the United States Congress. And yes, that be part of the first fully integrated stock exchange to come to America in 2 generations. Very exciting. Worked with the SEC for a long time. We believe we're on track to receive approval for our Form 1, Q3, possibly Q4, and then trading to start in the new year. And we are very excited. It's going to help put Texas even more on the map than we already are.
Since this has happened, as you know, there have been a lot of other exchanges that have made some moves. The New York Stock Exchange has now placed an equities exchange here. NASDAQ has a regional office here. So, Congressman, how do you handle this competition that came from that?
Well, imitation's always the greatest form of flattery. I'm not sure had the Texas Stock Exchange been formed, you would have seen this action. With respect to the New York Stock Exchange, number one, we welcome the competition. And unfortunately, we can't quite compete yet until we get our Form 1 approved by the SEC. But, you know, with respect to New York, they took a Chicago medallion and Federal expressed it here to Dallas. Again, happy to have them. NASDAQ clearly has an office, but we welcome the competition. We welcome the attention. And it really, in many respects, I think, validates one of our value propositions, and that is Texas is the place in America where people want to go to do business. And it's been the vision of Governor Abbott to make sure that not only is Texas the best venue to start a business, but to headquarter a business and now to incorporate a business and go public, trade, issue, all in Texas. And the Texas Stock Exchange is the next iteration to that. And we're going to have a lot of competitive advantages. But again, bring on the competition. It's a big state. Come on in.
All right. I love the ambition there. Let's talk about how you plan to compete, because one of the notions that's been raised is that maybe you need a few big anchor listings to really get the exchange off the ground once you list. And with that in mind, are you courting any companies at this moment to basically switch their listings when you do go live?
Oh, I think there'll be lots of companies that will will engage in dual listings. But Texas is going to be able to compete on a number of different fronts. Number one, we look very carefully at the economics. And we have a duopoly. I mean, that's just the fact of the matter. And because of that, we believe that there are efficiencies to be gained that can be shared with issuers. Next, Texas is going to be the issuer-aligned exchange. This is going to be a value-add proposition. Number three, there is going to be an advantage to list with a stock exchange that is actually based in Texas because of frankly, the political risk. Increasingly, companies have to calculate political risk. Texas has just passed 4 really major landmark pieces of legislation, one of which has to do with the fact that we're going to have written into our Constitution there won't be a financial transactions tax. They're threatening yet again to impose another one in New York. Technically, they have one. As you probably know, it's rebated. As a practical matter, they don't. In addition, on certain shareholder proxy fights, there's a very low threshold there. It takes up a lot of expense, a lot of C-suite time. There'll be a larger threshold, higher threshold in Texas. There's just going to be a lot of different reasons for people to come and enlist on the Texas Stock Exchange. And our CEO, Jim Lee, has put together the A-team. There has been a brain drain from the competitors. And already, as you may know, Dallas has more financial professionals today than New York. So again, we're going to have lots of competitive advantages, and as soon as the ink's dry on the Form 1, we're going to be happy to start competing.
Well, to your point, Congressman, I actually covered Rob Morocco and Allison Hennessy from NASDAQ and from CBOE coming over and joining with the Texas Stock Exchange, so that brain drain does seem to be happening. But I want to go back to the idea of switching listings, because one person and one company that has embraced Texas in a big way, of course, is Elon Musk. You have Tesla now incorporated in Texas. Have you been in any conversation with the team over there about potentially embracing the Texas Stock Exchange as well?
Well, I would say people at Texas are having lots of conversations. It's a little premature to talk about those conversations until, once again, the Form 1 by the SEC is approved so that trading can actually begin. We're very, very confident, again, there will be major companies in America who are going to choose to list and certainly trade on the Texas Stock Exchange, and there'll be co-listings as well. But you're already starting to see, again, corporations, one, move from Delaware. You've already seen a number of companies that will change their listings. Already you have so much of the trading that doesn't even take place on the listed exchange. There's lots of opportunities to compete, and again, there will be a lot of competitive advantages that we believe Texas will have.
Congressman, you just talked about CEO Jim Lee, and when we spoke to him earlier, he said he now believes with this legislative package that Texas is in direct competition with New York and Delaware. So I want to know, before we let you go, what defines success for you in the first year?
We have so far met all of our milestones so far. So I think simply being able to establish a world-class trading venue come in Q1 of the next year, that we start to have large Fortune 500 companies start to decide this is where we want to trade, and later in the year to be able to get new IPOs. And that's one of the whole reasons to start the Texas Stock Exchange. When I was in Congress, I cared deeply about the fact that we've seen this secular decline, if you will, in companies going public. I think Texas can help reverse that trend. So if you'll see that line start to flatten out, and again, we have more companies being able to go to the public markets and do it under the Texas brand, that will be success.
I really appreciate your time today. That is Jeb Hensarling of the Texas Stock Exchange, and our own Julie Fine, our Texas bureau chief. A great conversation about an ambitious upstart when it comes to the exchange place. Let's take a look.
Wait, did you say Y'all Street at all the whole time?
I didn't say Y'all Street, no, but thank goodness you did.
Yeah, because I love that.
Yeah.
Apparently they're calling it Y'all Street. So if someone says y'all to me in, casual conversation, right, I feel a little sick to my stomach. But if you say Y'all Street, I think that makes it cool.
And it makes sense because it rhymes with Wall Street. It's very cute. Stocks turned green, by the way, during that conversation, the S&P 500.
Yeah, not because of that conversation.
No, but it did happen.
And this is a pattern that we've seen lately. I think Dan Curtis was saying this morning 19 times in the last 100
That sounds like something he would say.
Sessions. All right. Gen Z says online dating is cringe. And Wall Street is taking note. Top Calls is next. This is Open Interest. Welcome back to Bloomberg Open Interest. We are 30 minutes into the trading day, and this market wants to push higher. Right now, the S&P 500 unchanged at 5934, some 300 points above where we were April 2nd. I'm Matt Miller alongside Katie Greifeld and Sonali Basak.
And a lot of things coming up for you this hour. We have an exclusive interview with two Wall Street giants. We have AQR's Cliff Asness telling us how he's managed double-digit returns in a volatile market. And Bruce Richards of Marathon is going to talk about cracks in that credit market. We've been looking at that long bond and a lot of questions about it. He'll answer them for us. But first, we're going to bring you some breaking economic data. Katie, what have we got?
So we have the JOLTS job openings for April. This is pretty interesting here, coming in higher than expectations, just about 7.4 million there. The expectation in the survey had been for 7.1 million. That is also higher than the previous reading of just below 7.2. You scroll down, you take a look at the quits level as well. Fewer quits than had been anticipated, coming in at 3.19 million, below the expectation of 3.27 million here. Of course, this is all the warm up for what we're going to get on Friday with that NFP report, but you can see a little bit better than expected when it comes to the headline number here.
2-year yield shooting a little bit higher than when it was earlier this morning, 10-year as well. Looking forward to that jobs print with you guys this Friday. Of course, you have Rick Reeder on of BlackRock as always. But for now, we are going to turn back to the broader market. How to navigate it all, you might be wondering. AQR this year has minted double-digit percentage returns in key strategies, and that comes at a time when many hedge funds have really been minting only marginal gains. The gains have been in long short, in multi-strategy, all with billionaire co-founder Cliff Asness's trademark quantitative investing approach all at the forefront. Asness joins us now. Of course, that is AQR Capital Management founder, managing principal, and chief investment officer. How do you do it? How do you navigate this market at this moment? Very simply.
Well, first, we generally do what we always do. We are quants, which means we spread our bets out fairly wide. We divide them into categories, and you mentioned a few of them. One major one, and the single best on the year, is individual stock picking. Now, for us, as you well know, that doesn't mean we visit one company, and we probably have about 2,000 longs and about 2,000 shorts, balanced by country and mostly, but not entirely, balanced by industry. That's been a super strong start to the year. Basically, every aspect of what we do is working, with the exception of famous value investing. I actually kind of love that, because sometimes people think of us too much as a value shop, so having a really strong period. But things like, are the fundamentals getting better? Is it a profitable company? Are they buying back shares or issuing shares? Is it high beta or low beta? We prefer low. Is the price momentum there? Including even some newer techniques, ML-based natural language processing, alternative data. It's been strong across the board, except my baby from 1990, value investing. But I try not to care. I just care about the total. The other thing really strong for us on the year is trend following. And this one, I'm going to brag now, because it's not been a good year for trend following in general. Price trends in the major markets have been a disappointment. There's been a lot of whipsaw, in particular April was a very painful whipsaw. But over the last, 7 years, we've diversified our trend following process to do many, many more markets, so it's more spread out. And importantly, to give a very significant weight, not just to price trend, but to fundamental and economic trend. And that's been great this year.
Cliff, I feel like I could do this because I've covered the tough times and the good times here. And right now, for the good times for AQR, it's interesting. Long-short fund, tracked by Bloomberg, is down about 1% on the year. You guys are up double digits. For long-short in particular, for the people who can't spread their bets across thousands of firms and don't have the machines at work to help, what can they learn? It looks like it's lower risk investments that are helping you out. What are you finding that works?
Well, the general philosophy quants believe in, and there's some differences, some of the more modern, again, the ML, the alternative data, this analogy doesn't work for. But the core things that quantitative investors believe in are not so dissimilar to what a classic Graham and Dodd investor would believe in. We believe in profitable companies at a reasonable multiple, where the fundamentals are getting better, where they're buying back rather than issuing shares, and all else equal. And it's always all else equal, because everything's done at once. We can love a company with a high beta, but all else equal, we prefer lower market risk. Obviously, as a quant, I'm not skilled at doing this, but if I were to do more concentrated investments, I would use these things as a screen. I'd use it as where do I fish? I want companies that look like this. Then a traditional manager's job is to get the specifics right. They can do wonderful and do things we can't do if they hit a home run in one specific stock, and they can utterly get destroyed if they get it wrong. We're betting on the statistical average of good investing working. They're betting on applying good investing to specific situations. And both can work and both can not work. But they are, in fact, it's a great question, because I think they are more similar than people sometimes realize in philosophy, if not in execution.
By the way, it reminds me of, when you say stock picking, I think of a random walk down Wall Street. Yeah. And when we were kids, the Wall Street Journal did this experiment where they had staff members throw a dart at a board. And often that was a better way to pick stocks than Wall Street analysts who were paid gazillions, or at the time, maybe hundreds of thousands of dollars, so.
Yeah, and I'm sure if they redid that study, it's still true.
Yeah.
If I want to get really geeky, I'll tell you that throwing darts gets you big, small cap, micro cap bias because there are a lot more of them. But the principle is correct. Active management, picking specific stocks, be it a concentrated manager or a very diversified long-short manager who's fully hedged, is inherently an arrogant act. I know anyone who's followed me will be shocked that I will do an arrogant act, but the average can't win. Jack Bogle was right. You add up everyone, it adds up to the market. Some people underperform, some outperform, and the average after fees and costs underperforms. So no one can get around from that. With that, we need active management in the world. We can't have a world of 100% indexing. That's a really weird world. What happens when nobody's looking at prices? Right. And good active managers, I think, can do well. But to believe you're one of the good ones is an inherently arrogant act. So I don't disagree. I certainly don't disagree with Burton at all. I do think for someone who doesn't think they have an edge or can find someone with an edge, that unfortunately he's passed, but I used to love to say, my friend Jack Bogle is not a bad alternative.
Right. And to that point, I'm speaking to David Booth, the co-founder of Dimensional at 12:30, and I believe we'll have a pretty similar conversation about that. But I want to talk about your market neutral strategy, your market neutral fund as well, because I was playing around with some charts. It's also up about 15% on a total return basis this year. It's outperforming the S&P 500 over the last 5 years, but a lot of that outperformance has come specifically from the past year. We were just speaking with Gargi Chaudhuri over at BlackRock, and she said that right now she would be looking at market neutral strategies. So why is market neutral working so well in this specific environment?
I'm going to give you a very unsatisfying answer.
Oh, no.
Because we bet on these multiple themes, and I'm only giving you a few of them. There are hundreds of factors in our model. And one thing quants are really bad at is telling a story about what. In fact, when we can tell a story, it's usually bad news. It's, value has gone so crazy, it's dominating what we do, and we have to stick with it. And it's come back, and the round trip has been good. There's a story. This year, there's been a tremendous return, X value, to what we would call basic rational investing. And I think you see that with maybe Europe outperforming the U.S., and that's one place value probably has helped because Europe has been cheaper. But the market has rewarded good companies that are getting better, that aren't too risky. We're not in a bubble period. And basically a bubble period is the only period I fear. Doesn't mean we won't do poorly at other times. I think we make money much more often than we don't, but we can get it wrong in any environment. But in a bubble, both valuation strategies and fundamentals get thrown out the window. And that is very hard for in those times. Sticking with your process and having the wherewithal to see it through, I think, can make you a lot of money round trip, including the tough times. But those are the tough ones.
Speaking of tough times, it looks like a lot of people are still keeping money on the sidelines for a rainy day. If you look at what money market fund assets have been doing, they've been drawn down a little bit, but not by very much. They've really climbed. What do you tell people who are sitting in cash and looking for the right buying opportunity right now?
First, you know a pet peeve of mine is the phrase money's on the sidelines?
Cash on the sidelines?
Yeah.
I've been hearing it for 25 years, Cliff.
Under the mattress?
Everyone says it, and what you generally mean is people have a bearish tint to them. But what I always, this is really geeky, but if you try to get to the sidelines and sell your stocks, you got to sell them to someone who just left the sidelines. With that said, I think a lot of managers are cautious, and a lot of individual investors, maybe less so on the individual side. Our view on timing the market. I co-authored a paper with one of my partners, Antti Ilmanen. I'm having a good day because I nailed his name. I've only known Antti for almost 40 years, but it's still, if you're having a tough day, he's finished. It's a mouthful. But we wrote a paper in Institutional Investor called Sin a Little, about timing the market. And it's a subtlety. You know, it's easy to tell people never do this, you're a disaster if you do this, and it's easy to tell people, even if it doesn't work out, get out now. But Sin a Little says market timing is pretty freaking hard. Combinations of basic things like trend following and valuation, we think do add some value long term when the market looks cheap and has been doing well lately on price and fundamentals. We do think you can overweight somewhat and vice versa. But the risk-adjusted returns on that trade are still low. So I think on net, we're probably close to neutral, maybe a little negative. Valuation is pretty bad, particularly for U.S. stocks. The trend has gotten weaker, but it's still, because we look it up to about a year horizon, still pretty decent. They're balancing out to a pretty wimpy view, but I encourage wimpiness on this. I don't know if there's anyone there who can do it, but I think the universe of people who can add a lot of value from really pure timing is exceptionally small. One element of hypocrisy, what we do in trend following, takes net long and short positions. So that will average flat the market. So in a very long-term sense, it is not timing. But short-term, of course, if you're doing trend following, you have longs and shorts. But even there, we spread the bets pretty far and wide.
All right, Cliff, we're going to hold you with us. We got to take a quick break to pay the bills, but Cliff Asness of AQR Capital Management stays with us. And we do also want to look at some of the single stocks moving at this hour, kicking off with Dollar General. You can see that gain 14% right now after easing investor concerns about tariffs. They upped their guidance, they beat the street, and they said they're going to raise prices a little as well. Constellation Energy, we told you before this block, lifting on its agreement with Facebook to sell nuclear power starting in mid-27, but everyone's super psyched on this, so that stock rallies. And then Pinterest rising after getting an upgrade from JP Morgan to a buy on its improved advertising capabilities. I use Pinterest all the time to save my recipes.
I've been using it all the time as well. I wish
true.
there was a way for me to easily send you my recipes over Pinterest. Now, coming up later this hour, we're going to speak with another Wall Street giant, of course, as well. We're going to go from the stock market to the bond market and bring in Bruce Richards of Marathon Asset Management, where he sees a hot trade in the credit market cracking. This is Bloomberg Open Interest.
Let's get now to high interest and look at what's making headlines around the world. Meta is signing a 20-year agreement to buy nuclear power from Constellation. As we've been telling you, it's the latest partnership between tech giants and nuclear power facility operators. The industry is trying to meet growing power needs of AI data centers, with something that Sonali focuses on a lot as well. So last year, Constellation said it would invest $1.6 billion to revive its shuttered 3 Mile Island plant in Pennsylvania and sell all of that output to Microsoft. Meta's just getting their piece. Warburg Pincus is aiming to raise as much as $2 billion to invest in assets that other private equity firms plan to hold for longer. The firm plans to back 10 to 15 single asset continuation funds and some unique multi-asset vehicles. Private equity firms are searching for new ways to distribute cash to their investors thanks to a prolonged deal rut that began when the Fed started raising rates 3 years ago. So that's why those continuation funds continue to be interesting. Wall Street may be calling it a golden age for alternative assets, but Richard Ennis, a retired investment consultant, calls it an expensive delusion that could drain billions from portfolios. The retired 81-year-old who helped pioneer the art of investment consulting recently conducted a study that found endowments and pensions that invested heavily in alternatives trailed market indexes by as much as 2.4 percentage points. Despite criticism, the alternative asset industry is still growing, with assets expected to reach $29 trillion by 2029. Was that a setup, Katie?
That was a setup, a really nicely executed setup, Matt Miller, for the next part of our conversation with Cliff Asness of AQR Capital Management. And Cliff, we were having this conversation last week on my podcast with Matt Levine, Money Stuff, about this push really to put private assets in the hands of retail investors, either through ETFs or interval funds. The list goes on. You said that you were going to hedge yourself, and then you said it's a terrible idea. And I'm hoping you can just expand on that a little bit. Why exactly is it so terrible?
If you're going to quote me to me, this whole thing's not going to be fair.
Was that a good setup,
I said that last week.
Yeah.
I don't. My opinion has completely changed.
Tell us.
All right. I have some cynicism about where we are in the private world. I've written about this. I don't think they're necessarily bad investments by any means. They may make a lot of money. My cynicism is mainly about people understanding the risks. We try to create assets that have very low correlation to markets by shorting as much as we're long. I think we make money long term. I think we made a lot of money long term, but that doesn't make a great investment. You have to do it well, but it does really hedge. It creates something that's not very correlated. Privates are simply long-only equities, usually with some leverage applied. And they look uncorrelated because they just don't tell you the prices very often. And they can. They could tell you every day, well, market went up and we know what our multiples are to the market and it's worth this today. So I don't think they're a true alternative, frankly, in the sense. They're an alternative way to buy long-only equities. And as such, they've gotten extremely popular, partly because many of them have done very well, but partly because we've been in a massive equity bull market forever. And selling equity exposure with reported risk that's lower, not real risk, but reported risk, turns out to be a great business model.
Right.
So it does feel like a crowded place. It feels like not having to market, being illiquid used to be, when David Swensen pioneered it at Yale, used to be a bug that you got paid for bearing. A bug is you don't want this. You don't want a liquid, so you need extra return to compensate you, and he was brilliant at monetizing that. Well, if it's a feature now, because it simply makes investments easier to live with because you don't have to look, you pay for a feature through lower returns. So there'll be winners, there'll be great firms. I think some of the firms out there, I won't list specific.
You could.
No, I'm not going to go there, but there are some I really think will navigate this well.
Yeah.
But as an industry, I think people think they're way too low risk, they're way too popular, and they may have market or sub-market returns as what was once a bug is a feature that you pay for in terms of return. So with all that said, hey, if you have those concerns, and you don't have to agree with me, but if you share those concerns, saying, hey, you know what we should do? We have all these things. You know who would buy this now? Retail? Doesn't always work out for retail.
Well, one of the pushbacks here, because private assets, of course, we're also talking about private companies. And there's the argument out there is that companies are staying private much longer. And some of the highest growth and most exciting companies, I'm thinking Stripe, SpaceX, OpenAI, the list goes on, are in the private markets. And perhaps retail should have access to that innovation. I wonder if that holds water with you.
Directionally, I buy the argument. There has been a shift to more private. It doesn't make them necessarily fairly priced investments. The private world has changed. It used to have more of a value flavor. The old LBO, this company is too cheap. It has somewhat, at least to my casual observation, switched to a little bit more of a growth investment, which also makes it probably a riskier investment. And it's a riskier investment that's still not reporting its daily risk. So I'll give you part of that argument. I wouldn't say private should not be part of a portfolio. I sit on quite a few investment committees over my time, and I never stand up and bang my fist and say we have to get out of these. But I do say we should be treating them as risky or more risky than the stock market. And that is not always the case. Sometimes you see, I'll be geeky for a second, well, like I'm ever not geeky.
Yeah.
If markets have a 15 to 20% annual volatility, you'll see people put out graphics where it's like privates, 4%. And yeah, those are the reported numbers. But I promise you the actual number is 32%. So if I worry about some institutions not getting that, I worry more about retail not getting it.
Sonali will explain that to me after.
I'll do it. 35 is bigger than 15.
No, I mean, if the numbers, reported numbers are 4. Anyway, I have a different question, a different kind of line of questioning here, which is, I think AQR is one of the most interesting, from an academic standpoint, firms out there. I mean, have always loved the quants, Jim Simons and everybody who's doing your work, because you're so closely involved with universities. And I think of the University of Chicago when I think of AQR, and I wonder what you make of this push to reduce foreign students studying here in America, because President Trump recently said he thinks Harvard should only have 15% foreign students. They have like 27%. I looked up University of Chicago, 24%. And you work so closely with these students and professors. So what does it mean to you?
Well, you know, I'm going to try to stay as apolitical as possible because I want to survive the week.
Yeah.
I will speak purely as a self-serving consumer of great researchers. We have found the great students at great PhD programs and even at great MBA programs to be a tremendous resource for AQR. Not all of them by any means, but a fairly decent number have been international students. And as a business person, I'm certainly concerned about that drying up. It's been a real talent pool that I think makes them better off and makes us better off. I don't think they're only taking American jobs if we find them better than the Americans. And we don't always by any means. There are a lot of great Americans, but reducing the talent pool for us is a negative, and I imagine we can't be the only one. So I think it is somewhat anti-growth to reduce the talent pool. Some of these people go back to their home country, but a lot stay in the United States. So there are aspects of what President Trump is doing. There's some messed up things in the university world, and he doesn't have a whole lot of levers, so maybe he's using what he thinks he needs to use, but this I don't like.
Broader administration strategy for a moment here, because we're sitting in this moment where you're seeing kind of that tit for tat and the tariff talks come back. You're also seeing the tax discussions underway in the Senate. Does the pro-growth agenda outweigh anything that you see as anti-growth? Or do you think that the anti-growth forces are starting to take over?
I think it's net more anti-growth right now. The tax bill, I might historically be kind of a libertarian, free market guy, but I can't tell you a few points off on taxes is going to send growth soaring. It usually has somewhat of a positive effect. And the tariff stuff, as we all know, it's so hard to know how it's going to turn out because it changes so rapidly. But if we get what I would call a bad outcome, considerably higher tariffs than we had before, this is one of the few bipartisan things amongst almost all economists. That is bad for inflation and bad for global growth. So the wild card is if a lot of this is negotiating, as some people claim, and we end up, you could conceivably end up with a better tariff regime if we play brinksmanship, but it's terrifying to some of us who think the bad outcome could be really bad. And that's why we see it's calmed down a little bit because people have maybe too much gotten a little complacent, but have stopped taking it as seriously. But every time there's we're going to raise tariff news, you see the numbers, and every time there's oh, we're easing off that, or we've extended the deadline, the market rallies, and I still think it's the case that seriously larger tariffs will be bad on every economic dimension you can
Cliff,
imagine.
Unfortunately, we're up against the clock. I have a producer in my ear. Really enjoyed this conversation. That is Cliff Asness of AQR. And for even more from Cliff, check out the Money Stuff podcast. It's hosted by me and Matt Levine, wherever you get your podcasts.
Jamie Dimon warning that a crack in the bond market is going to happen. That's because, in his view, the U.S. government massively overdid spending. He spoke at the Reagan National Economic Forum.
So if you look at economic history, bad things happen when those tectonic plates shift. It's very hard to see in real time. It is shifting, and this is one of them. I just don't know if it's going to be a crisis in 6 months or 6 years. And I'm hoping that we change both the trajectory of the debt and the ability of market makers to make markets.
Joining us now, Bruce Richards, founder and CEO of Marathon Asset Management. His firm specializes in public and private credit markets with over $23 billion in assets. It's interesting, Matt reminds me in the morning. I would look at the 10-year. It's the first thing I do every morning. We're only at around 4.4%. The market has been digesting this. We don't need to be in any state of alarm or anything like that, but a lot of people are really bell ringing about the deficit. How do you feel about the long bond?
I'm not a state of alarm either. And the long bond is of concern, but start with, there's three things guaranteed in this country: death, taxes, and deficits. And the deficits are becoming front of mind for everybody. And when you have the big, beautiful bill, which will probably add to deficit, pro-growth, and so, Besson and the theory is that we'll grow out of this. And Jamie Dimon even said it just a minute ago, that we'll grow out of this. The truth of the matter is we're running 7% of GDP in terms of deficits, and 7% equals about $2 trillion that we're adding to debt each year. And when you have a tariff policy that leads to a weaker dollar and maybe some indigestion by foreigners in owning our treasuries, and they own 30% of the treasuries, it becomes that much more alarming, because there's 10 trillion of treasuries at the current pace of what we need to roll off and refinance, as well as the new debt that we add, given the deficits, 10 trillion of treasuries in the next year to sell. And so while there's a big bid for the front-end treasuries, when you get out longer along the curve, the 30-year treasuries, it becomes a little more difficult to digest because it has some pretty big price risk. The duration for the 30-year treasury is 18 years, which means that if you raise rates 100 basis points, the price falls 18%. So it's a pretty big price decline. So you have these macro funds, hedge funds, that are starting to short the long end, knowing that the Fed's not buying treasuries and knowing that foreigners will be more reluctant to buy long end treasuries, and yet you have so many treasuries for sale. And so I can't tell you, I think rates are a really tough thing to call, and we try not to make a rate call, but earlier this century, GFC, long bonds were up around 6%. Could we go to 6%? Yes, and when we do, it becomes much more difficult to fund our government because of the higher interest charges.
Right. We had a great story, I think, yesterday that Double Line and TCW and PIMCO, they're in a buyer's strike. So even American companies are not buying our long-dated treasuries. Some of them are even shorting long-dated treasuries. Obviously, the foreigners right now feel a little bit offended by what's going on in trade, so they could stay out as well. And as a result, maybe Treasury moves issuance to the front end of the curve. Does that solve things? I mean,
it does, but it'll just put pressure on the front end. And the bottom line is, inflation's really well behaved at 2.1%. You'd think Treasury should be doing better on that basis. But the Fed knows that later this year, when tariffs really start to kick in, that we might see a higher inflation. I think the 5 or 7% doomsdayers are kind of off the reservation in making those calls. We think more like 2.1% PCE number becomes a 2.8 to 3.2 range, and that's reasonable. A 1% increase from here kind of tops. And with that, the Fed will want to see how inflation, factors through and before making a move. So the Fed's going to hold for an extended period of time, despite what the ECB is doing and the Bank of England is doing and the Bank of Canada is doing, which is to ease rates. The Fed will keep rates where they are now. The real issue, I think, is the knock-on effect. When you have higher rates, whether it's the front end or the longer end, and when you have higher rates, there's a crowding out. And so whether it's municipalities that have to pay a higher rate, whether it's companies that have to pay a higher rate, whether it's homeowners that have to pay a higher rate and get crowded out because they can't afford to buy that home, or the real estate markets, commercial real estate that is dealing with higher cap rates, there's this crowding out effect that impacts markets and impacts the consumer.
I want to double down on those risks because I want to be very clear about this. When we talk to big credit funds, private credit funds, the higher for longer environment has also meant higher yields, hence that golden opportunity. We get it. But I want to talk about the cracks because, to your point, if we do see long end rates remain higher, what cracks? Where exactly will that pain be? Because we're also equally hearing about people starting to want to dive into rescue financings. Are they worth it?
So it is a great time to invest. And as a lender, we're making returns that equity markets would wish they were making, and we're making these really high rates return with really low level of volatility. So our equity markets, the public equity markets have 16 vol. In the private credit markets, I can speak for us at Marathon, our volatility in our private credit lending books are like 4 to 6%. It's really low relative to the rate of return that we're making. So the risk reward is phenomenal, to your point that you're making. There are some cracks. The number one crack is the consumer. And so the consumer, if you look at the high yield market, you look at every sector across the high yield market. The high yield market is doing well. It's yielding 7.5%. You know, nice spread of 350 off. It's doing great. But there's one sector that's underperforming and negative on the year, and that's, you know, consumer discretionary type, you know, retailers and that sort. And so we've been avoiding that because we've understood that the consumer would be weak in this type of marketplace and consuming less because of the higher inflation that we've traditionally seen and now higher rates. So there's one sector that's really causing me to take a lot of pause, and it's software.
That's interesting. We talked to Gargi Chaudhuri from BlackRock earlier, and she loves software, right? Especially because of AI.
You have to love software because of AI. And when you have AI-first software companies, and that's what Google's becoming, that's what Microsoft is today, that's where Salesforce is moving towards, and Snowflake and Adobe, and these big incumbent companies that will see enterprise value even soar further from here, given AI. It's hugely positive. Do you know, Matt, that there are 5,000 companies owned by private equity? 5,000 that are software companies.
5,000 software companies owned by private equity.
Owned by private equity. And not all those companies will make the AI adjustment. And there will be creative destruction that comes their way, which will make them much more valuable because they'll make that adjustment. And so when you look in their data room of how they've performed, the PE sponsors, how their software firms have performed, you'll see companies which have much higher multiples because of AI. The exact point that she was making that you were making, right? But then you'll have a bigger cohort of companies that'll have that blockbuster moment video. Think about Mark Andreessen. Mark Andreessen making this comment 15 years ago that AI will eat the world, and AI has done a lot for the economy, done a lot for the equity markets and wealth creation. Now his new saying is AI will eat software. And so what software companies will make it through? Now think about being a lender, Sonali.
Right. This is a private credit blockbuster moment?
So because our loans are capped at par, we don't have the upside of equity, but we have the downside if there's a default. Marathon manages the never having a default, let alone a loss. And so we're avoiding software companies. I think private credit has somewhere between 20 to 30% of their book in software-related companies. And I think that when you make a private investment that you have no real exit, and it's a 5 to 7 year loan, you can't sit here today and tell me that this company, it's a software company, a traditional software company, can make that switch to be an AI software first company. And so I think they have all the downside with none of the upside other than getting your coupon, your cash flow on par. So I think those spreads need to be a couple hundred basis points wider. I think the debt to EBITDA ratios that they're lending at, which has been very, very high because the ARR, because the recurring revenue, needs to be considerably lower. In fact, we're taking a much greater degree of position as it relates to these software companies in the private credit markets by saying time out. We're going to wait and see for a period of time how it settles in and which companies can make the transition and which companies can't. But I think the default rate will go from 1/3 of the marketplace that you see in software relative to the market to 3 times the default rates of the traditional marketplace. So I think it's a great place to invest as private equity and as equity, but it's not such an intelligent place to invest if you're private credit capped at par on these software companies.
Bruce, we have to leave it there, but I've got to say that was the hottest trade for a while there in the private credit market.
Yeah, well, I mean, it's so
fascinating.
It reminds me of the time Business Week did a whole issue on learn to code, right?
Yeah.
And at the time, it was like, oh, everybody in the whole world has to learn to code. Well, guess what? With AI, you can forget all of that.
I'm glad I didn't spend too long on it, honestly.
Yeah. Bruce, great having you on the program.
Matt, thank you.
Thank
I
you,
really
Bruce.
appreciate
Good
you
to see
coming. Great to see you. Bruce Richards there of Marathon Asset Management. Want to get a look at some of the single stocks moving at this hour. Broadcom is one of those shares hitting all-time high just now. The company reports results on Thursday. Signet Jewelers also raising its profit outlook for the full year and lifted the low end of its sales guidance, signaling confidence in the new CEO's overhaul strategy. And this is a consumer story. I guess if you're going to buy a class ring, you're not going to get stopped by concerns about AI taking your job. Also, Hims and Hers Health says it's buying privately held telehealth company Zava as it looks to expand its footprint in Europe. That's been an interesting stock to watch.
And we had some news out of JP Morgan this morning as well. Let's take a check on that as well, because we have been seeing a lot of news coming out of the house of Jamie Dimon just about a day ago, saying that he's several years away from stepping down perhaps. And now today we're learning that Marianne Lake is taking on more responsibility at the bank. She's going to be leading strategic growth and the firm's fast-growing overseas consumer bank. Now this comes after the departure of Sanoke Viswanathan. Lake, though, is seen as a leading contender, one of the leading contenders to take over for Jamie Dimon. Remember, a couple of months ago, Jen Pipsack had said that she's probably not going to be the one stepping up to take that job. We have Sanoke Viswanathan, who is another talked about contender, maybe not as much as Marianne Lake, also leaving. So the spotlight becomes more on Marianne.
I think it's interesting. I mean, Jamie Dimon used to always say 5 years until he retires. Now it's multiple years, but
several.
He's only 69, right? I think we're in a new world, not just in terms of AI, but look, the president of the United States is a decade older than Jamie. He's going to turn 79, I think, next week.
Several is technically 7, right?
Several? No, I think several is anything more than 2.
Okay, let's see how literally he takes it. Anyways, we're going to speak to the company behind legacy software company AutoCAD on the state of home building. The CEO of Autodesk joins us next. We're looking forward to that conversation. We're going to talk about how the macro is impacting his company. This is Bloomberg Open Interest.
Multifamily home construction driving U.S. housing starts higher as the housing industry as a whole struggles to gain traction. Let's get a read on that from the engineering side of things. Andrew Anagnost joins us right now, the CEO of Autodesk. Autodesk is a global technology platform specializing in architecture, engineering, construction, best known probably for its AutoCAD software. And Andrew, great to have you on. What's your view of the housing market right now? What's your view of the building market? How's it going?
Yeah, so first off, Autodesk is involved in designing, making everything in the world. AutoCAD, standalone AutoCAD is only about 20% of our business right now. A lot of our business is in the cloud, based in AEC, infrastructure, manufacturing. And when you look at the home market in particular, I think it's important for us to realize that building more homes, multifamily residence, single-family homes, is not just a productivity problem, it's also a policy problem for the United States. We're definitely working on the productivity problem. We're trying to bring the ecosystem closer together. There's 2 things that we're trying to do here. One, we're trying to digitize the ecosystem more so it's more efficient and the cost per home is lower, coordinated more tightly with the infrastructure build-outs required. But we're also trying to bring industrial methods to the residential construction area, especially multifamily residential. And Matt, what this is, it's kind of pre-construction where you prefabricate components of the house or the building off-site and then assemble it on-site, or modular construction. And you can hear a lot about some of these things going on right now in the build-out post the LA fires, where people are leaning into modular construction and things like that. So between digitizing the ecosystem and moving to more industrial methods, we'd like to help build more housing faster in the U.S., but we'd also like to see some of the policy issues addressed too that allow us to build more everywhere.
I just want to ask about your business, because I always think of AutoCAD, and if it's only 20% of Autodesk revenues, what's the lion's share of your business? What makes up a bigger piece?
Yeah, so we're actually the 3D design and make company. So the products that are used more broadly are things like Revit, Fusion for manufacturing. Revit's the 3D modeling application for building design and infrastructure design. Fusion is our industry cloud for manufacturing. It's very prevalent in mid-sized manufacturers. About 12% of our business is cloud native. We have a huge business in construction management in construction cloud. It's part of our Forma industry cloud, which is our next generation AI-powered cloud for the architecture, engineering, and construction industry. So yeah, standalone AutoCAD is only 20% of our business. Most of our business is in 3D design and in make processes like manufacturing and construction.
There are a few complications when you think about the construction industry, the housing industry, but I do want you to weigh in on the administration's plans, because coming into the election, both sides of the aisle were very loud about the housing affordability crisis, but when you look at the cuts that are being made to the U.S. budget, it's actually housing assistance that is facing some pushback. Now, net-net, when you think about the broader administration policies, do you think that the current plans will fuel housing construction and housing affordability, or does it detract from it so far?
You know, here's the thing. Housing policy and housing construction is really a local thing. It's cities and states that drive most of the incentives or disincentives to building things. So with regards to the federal government, I think we should be looking more locally in terms of how we address some of the things that either accelerate building more or get in the way of building more. And like I said previously, we need to drive down the cost of building these things so that every opportunity is maximized so that we can build things effectively, sustainably and resiliently. But the policy issues are much more local than at the federal level.
That makes sense. I want to ask, you know, at the federal level, one of the things that we see President Trump really trying to do is get manufacturers to reshore, bring production back to the U.S. And you mentioned how much of your business is in that kind of, I guess, machine tooling, right? So do you see that happening already, Andrew? Or are we seeing factories come back? Are there practical problems like finding enough land, putting up the buildings for factories? Can we use the old ones that are abandoned? How does that look to you?
We are big believers in building locally and building up supply chain capacity locally. We've been working on this problem for 10 years to drive down the price of technology so that the small players can have the technology power capabilities of the big players. And one of the things that's really important for us to realize, this is not just about bringing large assembly factories back. That doesn't solve the problem. What you need to do is build out the ecosystem. And that's the small mom and pop shops all the way up to the mid-sized manufacturing facilities that build the parts and sub-assemblies that go feed the big manufacturing assemblies. So it's not about Hyundai or, you know, auto company X, Y, or Z building a factory here in the U.S. It's about us building supply chain capacity in the U.S. That's going to take time, and that's one of the areas we're focused on in terms of technology. We want the little guys to be able to modernize and be as powerful and automated as the big guys are so that we actually have that capacity.
Andrew, one thing I'm really curious about before we let you go, at the end of April, you entered into information sharing pact discussions with activist investor Starboard. How are those talks going? What do they want?
You know, we're actually really happy about the settlement we've got with Starboard. We're moving forward now. We agree on the margin expansion kind of goals for Autodesk and what we're trying to do moving forward. So we're happy with the outcome. We're looking forward. We're moving towards the future, and I think we've got that behind us now.
All right, Andrew, thanks so much for joining us. Really appreciate the look at your business. Andrew Anagnost, from Autodesk, talking to us from Boston. Coming up tomorrow, the Bloomberg Tech Summit gets underway. That's on the other side of the country in San Francisco. We're going to hear there from industry leaders, including the CEOs of Uber, Rivian, and Peloton, still exists. Catch a special edition of Bloomberg Technology live from the event on Thursday at 11 a.m. New York time. This is Open Interest.
The market has rewarded good companies that are getting better, that aren't too risky. We're not in a bubble period. And basically a bubble period is the only period I fear. Doesn't mean we won't do poorly at other times. I think we make money much more often than we don't, but we can get it wrong in any environment. But in a bubble, both valuation strategies and fundamentals get thrown out the window. And that is very hard in those times. Sticking with your process and having the wherewithal to see it through, I think, can make you a lot of money round trip, including the tough times.
And that was Cliff Asness, the billionaire co-founder of AQR, speaking earlier on Open Interest. And in a lot of ways, Matt, it's really interesting. When people felt bad when the market was drawing down a little earlier this year, for many others, it's been an opportunity. It's actually kind of a blessing in disguise. This idea that you can focus on valuation rather than straight value investing and actually take on a little bit of risk.
Yeah, I mean, it's interesting that we've come so far back from the market lows, right? And we're still we are at and above levels that we saw on August 2nd. We closed at 5,600 and change before President Trump brought out the big tariff boards on the White House lawn. And now we're looking at 5,950. So, wow, and the market is back up again, really wants to rally.
Right, just about a week ago, I was bothering you every day about reaching that 5,900 level. Now we can talk about 6,000 once again, and maybe then we can talk about 61. But also, to your point you've been making, I throw my hands up and say the 10-year has been calm.
So far.
So far.
So far.
So far.
Look, it's still something that I watch every day as well, Sonali. And the concerns are out there that we see a blowout in those yields, but not right now. Coming up tomorrow, we're going to speak with Stephen Wise of Carlyle. He's the co-head of the American Private Equity Group, live from the Super Return Conference in Berlin. This is Bloomberg.